Welcome back in, everybody. So we have a lot to get into in this video. Some of the things we're going to be talking about is a little bit more macro in the beginning of this video. I also want to just mess with my analysis on Pfizer and then also look at Pinterest earnings, kind of dig through that a little bit as well. Those are some stocks that we've talked about in the past, and I just want to revisit really quick. Now, with Donald Trump taking over as president, there's massive shifts taking place. There's going to be tension and there's going to be a lot of volatility, which then leads to opportunity. Now, as Peter Lynch stated, if you spend 14 minutes on economic data, you've probably wasted 12 minutes. And I do agree with this, but I also think that macros do matter. Now we're in a new regime, we have a new president in place, and volatility is definitely getting a little crazy. Companies that have a lot of exposure to China are now starting to get a little bit volatile. We obviously know about the big pharma, and a lot of times I do think that this is a buying opportunity. Because if we go back in time and we think about Joe Biden getting elected and really focusing on clean energy, not drilling as much domestically, we all thought that energy could be an underperformer. But if we take a look at over the last 5 years, energy was up 57%, which is basically in the middle of the pack here, and what really pushed the market was obviously technology, with a massive outperformance of 162% over the last 5 years. We can see here as real estate is the largest lagger, which could make sense because we were in an environment where it was higher inflation, interest rates were on the rise, and so this definitely limited the growth of real estate. And we also saw a dynamic shift in commercial real estate. Not as much office space is needed. A lot of people are more at home, reliant more on technology and a convenience of work-life balance. And so my expectations are, with Trump now in office, I think market volatility is going to be extremely high. Let's think about this. When we talk about possibly ending 2 land wars and raising tariffs on a country like China, this is going to be met with a lot of conflict, a lot of scary headlines, a lot of companies that are exposed. The picture is a little muddy here, but there's definitely opportunities presenting themselves, which is leading me to the vaccine makers first and foremost. Much like we talked about with Biden, thinking energy was going to be an underperformer, it actually performed fairly well. And I take a look at these pharma companies and they are selling off, which could lend a buying opportunity, and they could be outperformers, very similar to Biden and energy. We could be looking at Trump and big pharma. Now, Pfizer for me is kind of the highlight because I do like what's in their pipeline. I like their track record. And from a valuation perspective, they are trading at one of the cheapest valuations we've seen them trade for. And so for me, when I was looking at a very expensive market, this was a stock that kept coming up on my screen as having a good dividend, being around for 100+ years, valuation was appropriate. There's a lot of fear around the company right now, which could lend to a possible buying opportunity. The question becomes, how much of this macro environment is going to impact a company like Pfizer? Now, a lot of people are probably not interested in technicals, but there were some technicals pointing to a possible sell-off here. We have a left shoulder, a head, and a right shoulder that formulated here. And then take a look at this sell-off, which I do think we are going to find a bottom pretty soon in the stock. Now we have as low as a $25 price target, as high as a $45 price target. And if we take a look at what earnings projections are for Pfizer, we can see here that they're projected to do right around $2.90 of earnings. And if we put a 10 multiple on that, this really puts us close to a $30 stock. And expected revenue growth is going to be fairly minimal going forward, but we can see that EPS growth following as the company gets more and more efficient. So here is my model right in front of you right now. In 2025, I had them doing a similar amount of revenue as the projections are out, of $63.6 billion of top line revenue, and then have them steadily growing 3 to 4% as more and more things come through the pipeline. This is obviously a projection. So this is where the art of investing comes in, because this is my thesis on the company. This is the bias I'm building for the company. It doesn't necessarily mean that this is going to happen, right? The margins could be less, the revenue growth could be less, and a lot of things could dictate the price going in a different direction, higher or lower. So this is really subjective of what I think the company can do. And so with those projections, I get close to a $26.50 stock price with a future value pushing over $50 a share, which seems pretty reasonable. But now the question becomes, how much of this administration is going to impact margins? Because one of the things that they're talking about is price gouging, and how much is going to impact the vaccination side of their business. And so when I look at what they're doing, they're growing other aspects of their business that's really getting overlooked by the market. But there was a substantial revenue increase to Paxlovid, which is a remedy to COVID. And we all see that RFK is not on the COVID train. So how much does this administration impact margins and revenue growth on Pfizer. And let's just say I bring things down a little bit here and I say they do 1, 2, and 3% revenue growths and margins take a small pullback here. So if we go off of that basis, we can see here that you're basically looking between a $20 to $24 stock and a future value of $40.70. So just those little impacts make a huge difference on the future value of the stock. And so even though I think this could be a substantial buying opportunity, I don't necessarily think that the big pharma is out of the headlines yet. And the more that we see negative news and negative sentiment, the more I think we can see the sell-off and actually get a better entry point. But longer term, I do think that these companies are going to be just fine. And I think that a lot of this could be a pretty substantial buying opportunity for long-term investors. But once again, the picture is very, very unclear on this, which is now going to lead me to Pinterest, a company that I'm very interested in. I really like the dynamic they bring to social media, and I think it's getting interesting with the recent sell-off here. And we've seen this steady top-line revenue growth, consistently double-digit top-line revenue growth. And I do want to point out the outstanding shares increasing and the inconsistency of EPS, which you're normally going to get with your growth companies. Price targets as high as $50 at as low as $33. And most analysts are still expecting double-digit revenue growth, with EPS to soon follow here. So when we look at the promotional piece, a lot of things to like here. Q3 revenue grew to $898 million, an increase of 18%. And then they had a record 537 million global users, increase of 11%. So you do want to see ARPU growing and you want to see this double-digit user growth increasing, and you will definitely have that nice top line revenue following. And here's what I want to point out. They really highlight the net income growing 354% from 6 million now to 30 million. And trust me, this looks great on the outside. So when we go to their Form 10Q, and we go down to consolidated statement of operations, what they're doing from an operational standpoint here, we have that nice top line revenue growth that they pointed out of 18% growth, cost of revenue, research and development, sales and marketing, general administration, and we take it down to what they made from an operational standpoint. And they actually lost more money this quarter than they did the prior quarter. Now, from a 9-month standpoint, we can see that they're getting more efficient, but from a 3-month ended year over year, they're not as efficient. But what do we see? Interest income grew by $6 million and other income grew by $3 million, which then made the earnings report look a lot better. We bring it down to an EPS standpoint and we're looking at 5 cents from a basic and a 4 cent from a diluted. And we see that they added about an additional 9 million shares as well. So with the amount of cash that they're sitting on and interest rates being higher and their investments, we see here that interest income was up substantially and other income jumped from negative 4.5 million to a positive 3.2 million, which is over a $7 million swing. But when we look at it from a straight operational standpoint, that's where it's getting a little confusing. Research and development jumped up $60 million. Cost of revenue jumped up $17 million. And general administration jumped up $35 million. So yes, while that top line revenue is nice, there's inefficiencies here. Now, as you guys can see here, I have about a $25 to a $20 stock price. We average it out to about $22.50 ideal stock price, with a future value sitting closer to $58 a share. And that's with projecting out 2025 revenue to come in right around $4.1 billion. So for Pinterest, the one thing for me is that consistent ARPU growth, the consistent revenue growth, but also the most important thing is going to be watching those margins grow. Can they finally get those margins to grow? Because as we saw, the operational income was still negative, and actually more so negative than the year prior. So I'm taming down my growth rates here and saying that with my projections, this is me projecting out what I think they're capable of doing. They need to get margins on the right track here and making operations a little bit more efficient. I'm not comfortable using high growth rates into too far of futures here. As you guys can see here, I'm using 12% growth rates. They're still growing around 18%, but I do think that 18% is going to go down to 15 and then 10 and then 9. And so for me, I'm using 12 across the board, 9 and then 5. Now, obviously I could use higher growth rates, but I'm also trying to build some safety here. Then I'm saying their EBITDA margins are going to go from 10% to 15% and possibly start getting closer to that 25% EBITDA margins, which I'm using 22% by 2032. If we go off of that basis here, I'm basically looking at a $20 to $21 stock price and a future value sitting around $47 to maybe $50 a share if they outperform. So as always, guys, that was my dive into Pinterest. Really appreciate everybody's time, and we will see you all in the next one.